We still have attendees rolling in, but in respect for everyone's time, given that it is a little after 10 o'clock, we'll go ahead and get started. My name is Grant Swartzwelder, President of OTA Environmental, host of the Oilfield Strong webinar series. We started this last March during the COVID issue and have continued to go ever since with, I think, some pretty interesting presentations. This one I'm looking really forward to because it's a real-time discussion on how to create an oil company during this really tough time. I urge you to look on our YouTube channel. You can get there by just looking for OTA compression. It has all the previous presentations, and it'll also have this one in a couple of days. Give us time to load that on. And if you'll find other presentations from Chuck Yates, David Hayes, politicians, TCQ director, just a variety of presentations there. I want to point out I'm getting fancy with my backdrop here with the rigs. I was telling Don the story of that. This was a yard in between Midland and Odessa where they stacked their rigs. 4 years ago during that bust, I was driving around with a salesperson, and they decided that they should really go and call on this area because of all the rigs that were there. That must be a lot of activity. Clearly not understanding what stacked rigs do versus not. They were not the best salesperson around, so they moved on. But anyway, well, I want to welcome Don Burdick to today's presentation. I've known Don since my time in Midland. We played basketball together. He was faster and better than me then, and has continued to be that way, I believe. But he has an illustrious career in acquisition, divestiture, and geology, working corporate entities, but a lot of private equity as well, successfully doing exits for his own company and for a company that he's been a partner of. So he's a fantastic presenter for this topic. The topic being really focused on how he was able to get a transaction done last year during just as we all know, a horrendous time of the industry. He might be the only one I know that really got a deal done kind of from a private equity based type size. So Don, initially, first welcome, and then second, I'd like for you to kind of just give everyone an overview of kind of what you were able to achieve and some of the high points and low points, because there clearly were some of both. So welcome.
Sure, Grant. Yeah, thanks. And you're right. I do remember those days at the Midland Y playing some hoops. You know, we'd get together after work and just burn out the day's stress. And those are actually some really good times. I'm glad you brought that up. I remember them fondly. Midland, Texas, what a great place to start our careers, right? I mean, you know, as a kid out of North Carolina, had gone to OU for grad school, got my first industry job with Marathon Oil. You were over at Arco, if I remember right. Is that right?
Arco still existed at the time.
Yeah, and there we were, just sort of surrounded by this wonderful entrepreneurial culture. I mean, if nothing else, Midland, Texas gave me this sense of the type of people who are in the oil patch, who don't sit around when there's trouble. I think of the ERCOT stuff this past week. The oil patch people solve problems, and they, you know, I know guys were probably busting their butt to keep wells producing, trying to provide the hydrocarbons that people need to keep warm and keep the lights on. And it's that can-do attitude that I feel, and being exposed to that in such a meaningful way, that I guarantee you has helped me in my entire career, recognizing that's the way oil patch people are. So yeah, thanks for having me on. Happy to tell the story. I'm sure you know, some of the folks maybe have seen the Hearts A&D conference presentation of last week. If you know, I do a 30-minute interview with Steve Toon that kind of highlights this journey. The short summary, if you will, the guys of Olifant Energy I, let's call it, we were a portco of EnCap, and had attempted to repeat our previous success at Panther Energy II by going out to the Delaware Basin, leasing some acreage, drilling some wells, creating value, proving up production, and then selling that to a more interested, to the next interested buyer. That journey began in the summer of 2017. We completed our sale at Olifant Energy I in the fall of 2019. And it was I'll call it a capitulation sale. Wasn't a win. We were able to transact, but not at a price that made anybody happy. We were just glad to get the deal done. And at that point, we amicably parted from EnCap and began a journey as a self-funded entity, a group of 8 and eventually 9 people who were going to put everything on the line to try to create a new business, our Olifant Energy II, which in short term and in short description was going to be focused on acquiring a producing property, operating it efficiently, and using that business model to return value to our equity partners, service our debt and cover a G&A. And so that's what we pulled off to get Olifant II off the ground. Doing it in 2020 was a wicked ride, and happy to get into details if as the conversation goes along.
Now, so kind of walk us through how on this Olifant II, how you found the deal, and clearly, and kind of give us an overview, and then we'll talk about kind of what you learned from it, because there's clearly your experiences with the capital sources, debt and equity, and how that kind of came back and forth, and kind of lessons learned. But walk us through kind of, there were quite a few ups and downs on that.
Yeah, no, absolutely. So let's start then in October of 2019. That's really when this Olifant II journey began. And we were, at that point, we had enough cash to kind of cover a base G&A for a short period of time. And we developed a business model that that tried to acknowledge a few things. What's our cost of capital to go into a particular deal? What's a minimum G&A burn that we need to keep our team together? And then what kind of equity return does a co-investor need alongside us? So we kind of use those as the guideposts to say, when an asset came to market, well, to satisfy these thresholds, this is what we can pay for that asset. So it really wasn't so much about what the asset is quote unquote worth. It's what can that asset do to satisfy the financial needs we have in our enterprise. And so we proceeded to either negotiated situations or assets that had come to market. Our team would work them up. We had plenty of experience in the A&D world so that we could evaluate and come to a financial conclusion about an asset relatively quickly. And we would just, in many cases, throw out a bid, and we would lose. And we did that 11 times between October of 2019 and, let's say, April of 2020. Now I'll add a little bit of color. In January of 2020, after we sort of maintained let's call it a traditional G&A burn through the end of 2019, we kicked into a survival mode G&A. And what does that mean? We talked amongst ourselves and said, okay, everybody, we'd like to keep benefits for the team, but here's the cash we have in our corporate bank account. Now, I'm not talking about anybody's individual personal savings or that. It's just, what is this enterprise going to, what capital does it have available at this red hot second? And looking at that, we said maybe the best way to ensure survivability for the longest period of time is to go to a a minimalist G&A burn. So we had certain things, software, rent, fixed costs, but we dropped our salaries to minimum wage, 24 hours a week. That's what we paid ourselves. And that decision was made because as we looked at sort of the regulatory environment, if you will, to keep full benefits for everyone, which we wanted to do, that was the minimum we could do. So we did it. We just told everybody, live on that. Basically, your salary covers your copay almost on your benefits package. And we proceeded in January of 2020 to work that way and continued to make some, our valuations, make bids. And then in March, first week of March 2020, an asset came to market that really looked attractive to us. We worked up the bid, and in April, we were told, you're in the second round. For all the guys out there listening, you're in the second round. Can you do some pencil sharpening? We did. It leaned in just a tad more and ended up being the winning bidder. Going into that situation, we had had conversations with a number of different potential financial partners on the debt side, the equity side, and we had an initial very positive relationship with a family office for equity capital, and then a couple of different potential debt providers, such that we were able to model in how that financial structure would look, how it would work with the particular asset, and got, had very high confidence in the ability to close with these partners as we completed our bid process with the seller. And then the world just got wickedly crazy. I mean, it was kind of getting crazy in the middle of the whole thing, as we all know. That time period, March, the virus is hitting maximum panic mode. I believe it's April when we had our negative pricing on oil, late March or April, I forget now the exact timing. But financial markets were going crazy. We're in the middle of trying to secure this asset. And so from really the time that we won the bid till the time we crossed the finish line in closing, we had to adjust to different financial concerns and risks. And so our ultimate equity partner changed from one provider to a group of providers to then finally a third single equity partner. And our debt providers, we went through 4 or 5 before we finally found that winning combination. And it was just, look, everybody was trying to figure out the new world that we were going through in 2020, and that complicated the matter. But I think staying flexible, communicating well with everybody along the way really helped in us getting across the finish line.
So you signed up the transaction March, April time period. You closed in October?
We ultimately closed at the end of September.
End of September. And then I think the key point for this presentation is multiple iterations of equity, debt, and combinations thereof.
Yes, it really was. And it was just dealing with, you had financial institutions or partners who had their own, issues to deal with, being affected by the macro that we all saw with the virus and economic turmoil. So those entities were processing how they would survive. What's the future of hydrocarbons generally? How would this work? This was primarily a gas asset in Oklahoma. It was not something that we had any additional drilling plans for. That wasn't part of our business model. It truly was a PDP blowdown. And so understanding that, how you might hedge that production with our financial partners, and then, what was the appetite for risk and how did financial partners assess that risk? That was an active conversation back and forth, us trying to get our best grasp about mitigating risk from things like, LOE reduction, production performance, any sort of plugging liabilities, all those kind of things that we all deal with when you purchase a producing property. We're wrestling with those variables. Our financial partners doing the same, and then at times financial partners, some getting, feeling like the risk was too high, therefore their financial requirements got more restrictive from my perspective. And then somebody else might come in and say, you know what, I've got a different risk appetite. And so we would wrestle through all of those things. And, as we're talking about, I guess, a little bit before the broadcast here, the lessons learned, the lessons that we, I think, learned through this process and we kept active during the whole thing was clear communication, which I think I said earlier. And then this dedication, if you will, to flexibility. We would communicate with financial partners saying, hey, here's where we are. But by the way, we are talking to others just in case something bad happens with you guys. So it's not personal. We're going to have our agreements. But if people get nervous or want to change terms, we in the background are also working multiple partners just to keep our options open as well. And by doing that aggressively, I mean, that's what was required for us to get across the finish line.
Now, you mentioned family office initially. So was that part of your strategy, or you just happened to be on that? And kind of talk about the type of equity you talked to. Family office, did you talk to that more conventional private equity type funds? And kind of what was their appetite and what was their responsiveness of each of those categories?
Sure. So initially, because of our past experience with some of the big name private equity firms, we obviously talked to, sort of the laundry list of those guys, names everyone would know. And felt like we had good relationships, and we discussed our business model. And, at the end of the day, truth be told, the typical private equity return requirements on a PDP blowdown business model, it's tough. It's tough to hit their metrics. And in an honest conversation with each of these entities, we wrestled with it. We thought, well, do we tweak the metrics a little bit to still have acceptable returns for everyone? And it's just a struggle to do so. It can be done, and some guys are out there doing it, and I know the interest is there, but it's just not. It's not like our lease, drill, and flip model. Yeah, go ahead.
And you said PDP blowdown, but it's not really a blowdown like from an engineering standpoint, you think about a water flood or a gas flood and you truly blow down. This is an ongoing operation but it's PDP driven.
Yes, yeah.
Which seems to be what the market is allowing right now. That's
correct.
That's what all the existing private equity groups out there are converting from drill and lease, drill and flip to being a PDP model. So that's kind of what everybody is focused on, isn't it?
It is. I think it's the recognition that drilling economics struggle except in some of the best areas. And the risk factor, I mean, we all have gone through the idea that horizontal drilling is manufacturing and you just execute efficiently and you're going to be great. But parent-child issues obviously are real, and people are understanding that better now. And just the whole uncertainty about the hydrocarbon marketplace meant, for us, we thought that having a business model that required drilling to create the value or return value to our investors, we didn't see the appetite for it in the investment community per se, the equity investment community.
So how does that affect the standard private equity group, if that's really kind of what's out there, but their economics don't allow for them to invest in there? Seems like these conventional private equity groups are kind of stuck.
I think they're trying to figure out how does this work well for them. And honestly, now with the oil north of 60 and nat gas kind of hovering around the $3 an M, I think drilling opportunities will reemerge, but people are going to approach that very cautiously. the thing that really has fundamentally changed from, say, the previous, what is this now, 2021. So let's say 2019, the teens, if you will, where you could actually get paid for PUDs, get an acreage metric.
Yeah.
That's over in a material way. So you've got to have a business model that creates value that doesn't require that for your victory, so to speak. So yeah, when I say blow down, I mean I really am just talking about producing your property. What are the big knobs that you can turn? In our case, you can address LOE. So is there ways to make material improvements on your LOE component of the value chain? And then how do you arrest decline in a well? What can you do, and at what cost do you flatten your decline curve, in short? So those are, if I was to think of two big, simple, not simple, but simple to describe aspects of this business, that's what we focused on as a component. And then honestly, it's your cost of capital. It really is. It's your cost of capital with these kind of models. The ones who can get the lowest cost of capital have a competitive edge in pursuing these kind of mature assets that are not drilling.
So
Drilling.
the family office would seem like they would like more of this dividend model, this kind of lower risk type model that you're describing. What else did you see anything else that differentiated them from the standard private equity folks as far as how they were to work with, or terms, or do they kind of follow the same private equity model? What did you learn in that how the family office actually
Yeah,
works?
sure. And those, as you can imagine, the family office is as variable as the individuals in it. I mean, you really now have a personal relationship. You're dealing with somebody, I think, on their side and our side, if you will, that you're going to be talking to a lot. So you want to like the person, or certainly have that good professional respect and enjoyment in your communication. You need to trust them on both sides. There's a lot of trust involved. You have less of an institution per se, like the larger private equity firms, that has this filtering process and years of experience and all of that. You're dealing generally with a very small, much smaller set of individuals, and it's developing that relationship, understanding the risk appetites, understanding the risks involved. I mean, it's very incumbent on me and my team to accurately communicate the risks in our financial decisions, so that the investor group doesn't get surprised if 1 month the LOE is higher because you had to fix a well that went down, or whatever it might be. So
Did you find that their knowledge? Did you find that their knowledge in the industry was as how you're describing it makes it sound like they might not understand the oil industry as much, and because of that might not be as committed to the ups and downs, and so they might be a little more wishy-washy. Is that
well,
fair?
yeah. A great variability in the detailed knowledge. You've got family offices where their capital has come from other industries, other investments, and then they have recognized, in many cases, what I'd say the common theme we discovered was a financial intelligence in many of these family offices that recognized oil or hydrocarbons per se were undervalued. They had that, the investor group had that perception, believing that this could be an opportunity of a lifetime, if you will, or certainly of a near term, to take advantage of a valuable asset that was greatly undervalued at a macro level. So that's when you want to buy. That's, and the ones that I think have invested and partnered with ourselves and others like us had that appetite, had that belief. So that financial belief, though, didn't necessarily tie with a existing technical knowledge or industry knowledge. And so that's where it's important we felt with our team to try to communicate that well, make sure that if we found that right financial partner, that they had as good an understanding as we could convey to them about what really was at play, what are the risks, what could go wrong, and being willing to discuss that openly to get everybody on board as we began the adventure.
And most of these family offices, are they looking to be the sole equity, or are they trying to partner with others? Or it might be a size issue, but
Yeah.
I could also see that they like kind of being their own little fiefdom.
So the idea of multiple offices partnering together certainly presented itself in our case. But as we ended up, we have just a single family office that we have partnered with. There are capital constraints in that. I mean, it's not unlimited capital, so we are, working with the range, the appetite, financial appetite that our particular partner has. But they have also expressed a belief that should we need larger amounts of capital for the right deal, that they have relationships that could bring that extra. Use this term to describe our company. We're a multi-million-dollar mom and pop oil company. I mean, we're the corner store that does deals in some big numbers, but it's still very much a relationship business. That's something you and I learned in Midland, Texas, 15 years ago when we started, and
Yeah.
15 or some number like that. But those relationships that I'm back to fundamentals really of, clear communication, integrity, hard work. Those things still come into play, and maybe even more so in the family office world, because you really are dealing with individuals whose personal dollars are at risk. They're not just employees, they're engaged investors.
They're the owner. What
Yeah.
about, we talked about on the equity side, what about the debt side? How did you see, you hear a lot of banks either getting out of the energy industry or really narrowing down their fairway. How did you see that play out?
Boy, and that's true. So we had everything from some of the some multinational, really, they really are private equity again, but almost function as a bank with kind of a loan structure. So we had conversations with multinational entities, some of the larger, insurance companies and the funds that they sometimes will invest in oil and gas, all the way down to the national banks, the regional banks, all of those. We had conversations with all of those entities during our journey. And, at the end of the day, there's a cost of capital. How it's structured is highly variable. And you'll see entities go through multiple tiers, simple debt, simple interest debt, mezz debt, overrides, working interest components, initiation fees, variable interest rates, depending on certain thresholds and metrics. So it was really fun it was really fun to work through the myriad of opportunities and try the ones that were the best at it, figured out creative ways to accomplish their financial needs and yet still work with the business model that we propose. So everybody's out there looking. Yeah,
so
go
you
ahead.
didn't see like community banks being more interested, or the big banks, or the unconventional. You didn't see a theme as to who was more interested in doing this size of transaction.
We saw
You saw a little of each of those.
We did, and we also saw entities that maybe had been burned, that were now did not have an appetite, even though they had been traditional sources of debt capital in the past. Some of them had a upside down book of business, and they did not want to put any more in oil and gas. And others who maybe hadn't gotten into the oil and gas space yet and were hungry to do so. And sort of the whole loan to value proposition. We saw a wide range of potential percentages, a very, very wide range. And each of those had their structural complexities that we had to navigate. But for us, at the end of the day, strange though it may sound, we partnered with a local Oklahoma bank who we had developed a relationship with through the years, though had never actually done a transaction or investment together, a partnership together. And it was a local Oklahoma bank that said, well, here's what we can do. And that ended up being the most compelling offer for us in partnership with a family office.
And what do you think drove them to do that? Just they obviously needed to put some money out and they had a relationship with you?
Relationship, we do believe we put together a compelling financial argument. And at the end of the day, that's the driver for any of it. You've got to have that. And I think we demonstrated an attractive investment in for the bank in particular, gave them a high confidence that we could service their debt. So it was that. What enabled that partner to come across the finish line, though, I do think was enhanced by personal relationships, reputations of the entire team here at Olifant. But that we had other financial partners that we could have transacted with. But as we were negotiating terms, and again, I attribute much of the difficulty and variability in the financial terms to the macro of the marketplace at the time. Just everyone was becoming concerned about their assessment of risk. There were so many moving pieces. None of us really knew what all the black swans were in the air those days, and how that could negatively impact an investment. So we were all wrestling through that.
And clearly that was heightened last year, but I
Yes.
could argue that that's going to continue through this year. You see it, is your sense that it's the access to equity, access to debt, access to deals, is that improving, or is it still as choppy now as it was?
No, I think you're right. And maybe it's nothing new. It isn't anything new. We've really never been, just comfortably predictable in the oil.
2019, even before COVID, was not a good time to
That's
get
correct.
a deal done.
That's correct. So if again in the under the concept of advice to others or what lessons learned, it is I'll use this word again, the flexibility, constantly adjusting our expectations, our metrics, the way the asset, just the full understanding of the business venture, maintaining that flexibility and making the adjustments necessary in real time to satisfy the needs of your financial partners, and being willing to do that, whether it is a G&A change or a repayment schedule change or a deferred investment or whatever it might be. But
Right.
Those components.
And for our audience, if you have questions, go down to the lower bar to the chat. And if you have any particular questions for Don, I'd be happy to transmit those to you.
Sure.
I kind of working this backwards. I meant to bring up kind of the acquisition side because, I've been talking to a lot of folks that they go into these bids and then they get blown out by 20, 30%. It sounds like you had some of those experiences.
We sure did.
So how was this transaction different? Were you the one that overbid 20, 30%?
We were, and so we had the buyer's curse. Again, so what's involved, and I'll harken back a little bit to what I said. What's involved in that bid? The value of let's in simple terms, let's say the PV value of the asset as a standalone. Now, admittedly, PV is not like it's an absolute number that what's the PV 20, and we all know what that is. That's an interpretation as well.
Sure.
But
But it's easier in a PDP to,
it
if
is
you're doing it off PDP, you should be able to decline, and it's not as iffy as PUD or even behind pipe.
correct, correct. So you let the assumption being reservoir engineers are going to come within a understandable range of well performance. So what is the hydrocarbon production going to look like? And again, depending on the type of hydrocarbon and age of the well and all of those things. But assume you'll have a reasonable range with reservoir engineers on that. Then you've got what pricing? Do you do a strip price? Do you do a flat price? Do you do a climbing price? You know, what do you do in your price model? So that's another knob that people are turning that can give them a higher or lower value depending on what they do there. I'm back to the LOE. I mean, do you think you can make material reductions or not? And what's the risk of that assumption, either direction? Other components of the deal become maybe a smaller subset of the value adjustment, but those come all into play. And then it is, you know, it's very material. And we played with this a lot. This cost of capital and the return expectations. If your investment groups, your financial partners have certain expectations, you better, in fact, you have to model that in to make sure the asset can perform to those expectations. And sometimes if somebody's getting blown out, maybe it's their expectations were such that they could only pay X to hit those. And if somebody else said, well, I've got lower financial expectations, they could pay more. And that really does come into play. I think it's in a material way.
How did you handle, and I don't know if you have a lot of plugging liability or inactive wells in what you bought, but in some of these acquisitions you look at, I'm sure they did.
Sure.
But that seems to, in the past, that plugging liability just always kept getting pushed and pushed, and ultimately, oh, we'd sell it, and the buyer would just assume that. That seems to have changed. How did you handle plugging liability in your economics?
Sure. We built it in, and we have a regular expectation of plugging wells. And so we built that cost into our business model. We didn't defer it, irrationally into the future. We don't, our business model doesn't have a sale as its exit. So we plan.
It does not?
It does not.
Okay.
No. So our plan is, our business plan basically takes us to end of life with the wells that we have in all cases, including, plugging. We address, and I know you guys are very big on the environmental side. I mean, that's an issue that we modeled, anticipate. We want to be, great environmental stewards, as really, frankly, the oil patch is. I mean, the people who I know in this business, we do care about the environment. We were talking earlier. I mean, I'm a geologist. I got into this freaking business because I like hiking around and looking at rocks on a mountainside. So, none of us want to soil the environment. And as a small company, the last thing we want is any kind of environmental disaster or problem. So we very much are conscious of and appreciate the expertise that can help us make a good environmental assessment. And then we throw in our budget how we, maintain good environmental stewardship.
Well,
So
I assume
you can't ignore it.
your production isn't that a picture of your production behind you with the buffalo roaming and the green grass?
It is. We have all of
that's,
our facilities or we hide them behind a buffalo, and
Yeah.
so that the landscape is perfect. Yeah, this is since you mentioned it, this is an artist. Her name is Carolyn Mock out of Bartlesville, Oklahoma. Wonderful lady. She gets her painting inspiration from the Tallgrass Prairie Preserve, very close here to Tulsa. She's got a website if anybody likes the art, and I just love. I've always loved buffaloes. I mean, even as a kid, and Carolyn was displaying at the NatureWorks art show here in Tulsa a few years back, and I saw this painting and went, "Oh, this is perfect. I want this painting." So, but yes, it is an Oklahoma landscape. Uh, our our fields, our wellheads may not look this idyllic, but no, we try to be good stewards for sure.
So when you were getting this transaction done from an ESG and focus on the E, did you, in all the other transactions you've done, did you do your environmental due diligence any different? Or was it the same way that you've done all your other deals? Meaning, and because things have gotten heightened in the,
We've always, our team's always been very conscious of being good environmental stewards and also sort of addressing environmental issues on the front end. So I guess I'd say no, we really didn't do it any differently. We didn't do any shortcuts. We bought it from this asset we bought from Aventive, and Aventive was a good environmental steward as well. And so we examined the well sites and were comfortable that we were buying from an entity that had shared as much concern about being a good steward as we did, and that was helpful.
We have a question from the panel or from the audience about what programs you use to calculate, and there's simple ones to more complicated, working with other groups. Any insight on that?
Yeah, sure. So my co-founder and partner here, reservoir engineer at Olifant's a guy named Bill Martin. We use Aries. We're an Aries shop. And Bill is just a superior. I mean, I really have not worked with a reservoir engineer any better than Bill in terms of his understanding of Aries and how to model in the financial components of an oil field into that software and address the address the financial model with in great detail. So that works for us. But PhD Win is something we have worked with. There are some of the other packages out. I'm a geologist, so I don't know about all these silly numbers. I can't figure it out.
No, don't you just use maps and cross sections and say
color
it's all got to be in
color
there?
pencils, and I just like pretty colors and patterns, so I don't know these number things. But no, that's we used Aries as our primary economic software, but we built, for our purposes, just using Excel, we built a financial model that addressed the full components of a business plan, that we could take our Aries runs, dump them into this financial model that then allowed us to play with variables like G&A, like timing of distributions or debt service and those sort of things, so that Aries was the starting point, and then simply just an Excel model to enhance that to say, here's the full cycle business plan, soup to nuts.
Well, that's got to be impressive for the bank and the equity to have that type of, reserve all the way to P&L capabilities.
I know. I think it helped, and that helped we could articulate risk components, but when we can show the financial impact and the execution of all of that, it most definitely helped communicate, I think, and gave a confidence that we had addressed certain issues, we'd understand the financial impact, and we're able to put that into the entire business plan.
Well, Don, we try to keep this at 30 minutes, but I was finding it interesting enough that we actually went way beyond that.
Oh, okay.
No, I think it's great. Do you have give you a chance for any closing of any other lessons? I think this has been very helpful and appreciate it, but any closing comments? And
sure. I look at our team. I think we have a great team. Our ability to interact, culturally, nobody's shy. So if somebody's got an opinion, in fact, it's incumbent upon them to voice that opinion, and we wrestle with different ideas and different ways to solve a problem. But we're not any more special, honestly, than a lot of the talent out there. We were fortunate in the way some things came together for us. So as I look out, and I have lots of friends in the industry here, and as I look across the oil patch at other teams or groups that are trying to pursue something like this, keep at it, man. I mean, I would say stay encouraged, stay flexible, work hard and just keep after it, because honestly, there's lots of great talent, and you just need a little bit of good fortune to come your way, which we had, and you'll get there too. So, you know, chin up, keep fighting. There's so much talent in this industry, so many people who can make value out of difficult situations, that, you know, don't give up, because I know it's a hard time right now, but you can do it.
Well, just all the years that I've known you, you've helped a lot of folks, and you've kind of gained that equity because you've kept those relationships. You've you've helped others, and it kind of has a way of paying back, I think,
Well, so many
and
helped
having
me through the
and
years.
having
I mean, yeah,
and it helps with your reputation with the bank and the equity when they start doing the backup checks. So congratulations, Don. Thank you very much for doing this, and I'm so happy for your success. So um, with that, we'll stay tuned for the next announcement on our future webinar, Oilfield Strong webinar. We'll have this posted. If you have anyone that might want to see it, that'll be on our YouTube channel in a day or two. And with that, thank y'all, and y'all have a great day.
yeah. Thanks,
Thank you,
man.
Don.
See you, everybody.
Take care.